Different hot topics had dominated headlines in recent years. In 2013, the theme was QE tapering. In 2014, it was all about falling oil prices and deflationary risk. This same topic on oil price and deflation is still today a highlight in our headlines day in, day out, even though we have already moved past 2015 and into 2016. On top of the oil price slump, the slowdown in emerging markets have also been gaining more attention lately. The effect of the rebalancing in China on the anemic global economic growth shows that when China sneezes, the rest of the world catches a cold. Now, before we delve into the whole China conundrum, let's first take a look at this chart we are all too familiar with. A chart of the very commodity that has affected all of us, especially in the past 2 years. As we all know, oil prices started free falling in 2014 when shale oil boom in the US sparked oversupply concerns. Thereafter, the situation further worsened when OPEC decided not to cut its production in order to defend its market share. Therefore, since 2014, world oil supply had constantly outweighed demand every quarter. The global oversupply trend is expected to continue, especially with the lifting of OPEC member Iran's oil-related sanctions on 16th of January this year. True enough, the IEA reported last week the Iranian crude output rose from its average of 2.8 million barrels a year in 2015 to 3.6 million barrels per day, a level last hit in 2011 before sanctions were lifted. In recent quarters, oil prices sank deeper when weaker demand due to sluggish global growth caused the onset of a declining trend in world oil demand. And so, speaking of falling oil demand, where is this really stemming from? Reading, China. China is in the midst of redirecting its economic focus away from heavy manufacturing towards a more consumer-focused structure. In the past few decades, the robust growth of the world's second-largest economy was mostly driven by investments. However, in recent years, increasing concerns were centered around its shadow banking, from which the investments obtained funding. Moody's had recently reported that across all sectors, debt in China has increased to around 280% of GDP. Malinvestments, which resulted in overcapacity in various industries such as real estate, infrastructure, manufacturing, steel and coal, are also weighed down on China's economy. So therefore, China initiated a rebalancing program to shift parts of its economic blocks towards consumption. While it is a very concrete idea to sustain growth, it is not easy to achieve due to the country's high savings rate as well as low wages, which means low disposable income for consumption. As a result, the sluggish consumption coupled with slowdown in investments caused an inevitable drag on China's economy. With China now being such a big force in the global economy, its slowdown is expected to send ripple effects across the world. And that brings us to the next slide, the global economy, which is generally on a downtrend. 6 out of the 8 major economies shown here demonstrated a decline in economic growth. And the only one that had shown signs of improvements, Russia, was actually in a deep recession and still in the red as of the last quarter. This is not surprising, considering the fact that crude oil is one of the key inputs for its economic expansion. So as we look closer into the decelerating global economic growth, we note that 3 external developments have contributed to weak sentiments and consequently the slowdown. Subdued global trade, commodity slump, and financial market volatility. These developments introduced adverse impacts on the global economy, particularly for emerging markets, which typically exhibit high level of reliance on global trade and commodity exports. Meanwhile, heightened volatility in financial markets, coupled with financial stress around the Fed's tightening cycle, has prompted investors to shift to safe haven assets such as the US dollar and Japanese yen, resulting in capital outflows from emerging markets. As such, Economic developments in emerging markets have been gaining much attention as economists around the world believe that a slowdown in emerging markets poses legitimate threats to any recovery efforts of the entwined global economy. There's no denying that globalization has enabled us to stay connected with every part of the world, but this has also made the global economy tremendously interdependent. In light of China's rebalancing from an export-based economy to a consumption-based economy, emerging markets that used to enjoy the smooth ride of exporting raw materials to China, and assuming that China demand is a perpetual growth machine, has now hit a stumbling block in their growth. As shown in the manufacturing PMI chart here, 3 out of the 4 BRIC countries witnessed contractions in their manufacturing sectors for most of 2015 through to the first quarter of 2016. Note that the manufacturing PMI is an important indicator of slowdown, as the manufacturing sector contributes to a fair share of these emerging economies. Citing impact of persistent slowdown in emerging market, both the IMF and the World Bank had lowered their respective forecasts of global economic growth for 2016 and 2017. With these downward revisions in global growth estimates, projections for commodities also required trimming. According to the International Energy Agency, growth in global oil demand is expected to ease to around 1.2 million barrels per day. This is just 1/3 less than 2015's expansion of 1.8 million barrels a day. Ladies and gentlemen, since Malaysia is an emerging market ourselves, let's take a look at how we are doing. As an open economy, Malaysia is not insulated from the mounting uncertainties in the rest of the world. Our ringgit suffered a sharp depreciation over 2015 as oil prices collapsed. Our foreign reserves dipped below $100 billion, and for the year as a whole, growth in exports and imports moderated to just 1.9% and 0.4% respectively, as compared to 6.3% and 5.3% in 2014. And for the first quarter of 2016, Malaysia's current account surplus had halved to a 3-year low of 5 billion ringgit from a revised 10.5 billion ringgit the previous quarter. That said, we can draw comfort from the fact that Malaysia had weathered through the global developments fairly well, with a growth of 5% for the year 2015. And in the latest BPAM annual report, the central bank remains positive on the growth prospects of the domestic economy. The central bank projected Malaysian economy to grow at a steady pace of 4 to 4.5% this year, and that domestic demand will continue to be the key driver for growth amid weaker external demand. Just last Friday, the Statistics Department announced that the Malaysian economy expanded by just 4.2% in the first quarter of 2016 due to cautious private spending and decline in exports. However, the data still beats economists' expectations of a slower 4 to 4.1% growth, and the newly appointed central bank governor, Datuk Muhammad Ibrahim, had said that consumer spending will continue to drive growth as GST-related price adjustments pass, supported by government measures to increase disposable income. Meanwhile, headline inflation for 2016 is expected to range between 2.5% and 3.5%, higher than the 2.1% registered for the year 2015. Lower global commodity prices and subdued global inflation is expected to partly offset the effects from the weaker ringgit and increases in the prices of several price-administered items. In line with this, we see the average first quarter CPI for 2016 coming in at a higher 3.4%. However, bearing in mind that the elevated first quarter inflation was also a function of the low base effect before the GST implementation last year, analysts expect inflation to be moderate after this first quarter. In addition to Malaysia's strong fundamentals, the Malaysian bond market, as represented by the TR BPAM All Bond Index, had also provided investors with decent returns in 2015, despite challenges such as the ringgit's sharp depreciation, uneven growth rates in the global economy, speculations on the timing of a rate hike by the US Fed, and insinuation of economic mismanagement at 1MDB. The index registered a 12-month total return of 4.6% as at 31st March 2016 by virtue of steady economic growth and a benign inflation environment. Furthermore, BNM's stance to stay accommodative and hold the OPR rate steady at 3.25% had provided support to the domestic economy and financial markets. The SRR cut by BNM from 4% to 3.5% also helped ensure sufficient liquidity in the domestic financial system and indirectly supports the robust performance of the ringgit bond market. As observed in the chart, the index was on a steady uptrend for most parts of the year, even during the month of December, in which the US had hiked its key interest rate. The market's little or no reaction to the announcement came as no surprise, that because the market had already anticipated the end of the Fed's zero interest rate policy. However, the index did witness a sharp retracement in the months of August and September, giving back half of the gains accumulated throughout the year, as the release of bleak data such as the fall of the foreign reserves coupled with tumbling oil prices, as well as speculations on 1MDB unnerved the market. It is also during these months that the ringgit weakened to a 16-year low against the US dollar, and foreign holdings of MGS dropped to the lowest level for the year at 44.1%. Jittery foreign investors had rushed to offload their holdings of Malaysian government securities on the back of plunging ringgit. However, this proved temporary, as the recovery of the ringgit in the following month against the dollar and stabilizing market sentiment halted further outflows, and the foreign holdings of MGS recovered to about 46.3%. In March 2016, the beaten down ringgit emerged as the top performer in the region as oil prices recovered and as 1MDB pared down its debt through various asset disposal initiatives, warding off concerns about the state investment fund. As a result, foreign holdings of MGS increased to match the high seen in June 2015, indicating increasing interest in the domestic bond market by foreign investors. The state interest in MGS brings us to the next question. Which end of the yield curve drew greater interest? As we see here, the 3-year MGS yield eased 46 basis points in 2015, while the 10-year MGS inched up by 6 basis points. This implied a significant interest in shorter tenure sovereign papers, which was also partly attributable to Bank Negara's hiatus in its issuance of short-term papers up until end of July. Meanwhile, the 3 to 10-year MGS spreads widened to peak at 101 basis points in mid-December 2015, as investors turned more risk-averse and shortened their portfolio duration. This was also amidst heightened uncertainties and increasingly negative sentiments during the second half of 2015. However, with the recovery of the ringgit and dovish monetary policies adopted by central banks in the first quarter of 2016, the search for yield pickup continued, benefiting bond markets such as Malaysia. The MGS yield curve bull flattened in the first quarter, narrowing the 3 to 10-year spreads to 60 basis points. Over in the corporate segment now. Credit spreads had widened as corporate bond investors demanded higher premiums under an environment of increasing uncertainties. The quasi-government, AAA, and AA3 credit spreads widened by 19 to 25 basis points between January 2015 and March 2016. Although credit spreads seemingly tightened in the months of August and September, this was largely due to the surge in MGS yields on the back of foreign selling. Corporate bonds, which are generally held by local investors, saw lower fluctuations in yields as compared to the MGS, as they are less exposed to foreign selling pressures. Now, comparing the bond market performance with that of equities. The ringgit bond market, although plagued by foreign outflows and a weaker ringgit, continued to provide much better returns with relatively lower volatility as compared to the Malaysian and US equity markets. As at 31st March 2016, the TR BPAM All Bond Index recorded a Sharpe ratio of 2.95 times, a level that is significantly higher than that of the FTSE Bursa Malaysia KLCI and the S&P 500. As shown in this chart here, The ringgit bond market was the only market that provided positive rolling returns as compared to both equity markets, as equity markets were more adversely affected by risk-off sentiments. In terms of the size of the ringgit bond market, despite a challenging year in 2015, the total annual outstanding bonds and sukuk continued to grow to 1.13 trillion. The outstanding amount of sukuk in the market continues to outgrow that of conventional bonds. As of March 2016, the sukuk commanded a larger share of the domestic market of 54% as compared to the conventional at 46%. The mere marginal increase in the total outstanding amount in 2015 was due to the relatively quieter primary market in the first 3 quarters of the year. As compared to 2014, quarterly issuance trend in 2015 was much more sporadic as uncertainties kept issuers sidelined in some quarters. In third quarter 2015 especially, primary market activities dwindled to its lowest in more than 3 years, a period which even includes the taper tantrum year of 2013. Issuers were deterred from seeking funding from the bond market as generic yields and volatility surged during the quarter, and cautious market sentiment due to weaker economic prospects also resulted in cuts of capex spending. In the final quarter of 2015, however, we see bond issuance swelling as issuers rushed to lock in yields before the Fed increases their rate, as well as to meet Basel III capital requirements and the funding of some infrastructure projects. In the first quarter of 2016, primary market activity started on a relatively stronger foothold compared to the corresponding quarter due to higher crude oil price, the favorable ringgit, and resolution of domestic woes. For the rest of 2016, we expect issuers to hail from 2 major sectors among others. Firstly, financial institutions who are looking to replenish the capital base due to redemptions of existing callable instruments. And secondly, infrastructure-related projects issuers as the revised 2016 federal budget reinforces the government's commitment towards infrastructure development. Breaking down the 2015 primary issuance into credit segments, we note that PDS and quasi-government issuance generally eased as compared to 2014, while Govies issuance was flat. As for the annualized first quarter 2016 issuance amount, government bond issues is expected to be slightly lower, in line with the government's commitment to cut down budget deficit to just 3.1% of GDP. And similarly, PDS saw a general decline as the cloudy outlook in the global and domestic economies kept issuers at bay, while waiting for a better window to tap the market. In market share by principal, sukuk issuance constitutes a larger share for 2015 through to the first quarter of 2016 at 58% as compared to conventional papers. As seen in the issuance breakdown chart, aside from the MGS issuance, Islamic principal papers dominated both the quasi-government and PDS segments. This is in line with Malaysia's aim to be the leader in Islamic finance, as already proven recently by Malaysia's emergence as the global leader in Islamic banking and finance, according to the Global Islamic Finance Report 2016, surpassing Iran for the very first time. As with previous years, infrastructure-related bond issuers were among the top 10 issuers in 2015. This year, we see the names of Dana Infra, Prasarana, and Jima East Power as infrastructure projects such as the MRT, LRT, and power plant projects continue to contribute to the expansion of the Malaysian economy. Other notable top issuers include the property and construction group Sunway Berhad, as well as Chagamas Berhad, which continues to command an important position in the domestic bond market as one of the largest PDS issuers in Malaysia. As for the secondary market, the quarterly liquidity assessment showed that trading activities declined from a total trade volume of 1.4 trillion in 2013 to just 974 billion in 2015. It is noteworthy that the total trade volume has been on a downtrend since 2013, the year in which the Fed had initiated monetary tightening cycle with the QE tapering, thus inducing outflows from the domestic market. However, in the first quarter of 2016, trade volume in the domestic bond market picked up as the ringgit recovered amid general dovish tone among central banks around the world. This has helped entice foreign investors into the ringgit bond market, thus boosting liquidity. And as per the norm, government securities and higher grade segments were still investors' favorites. As shown in this chart, AAA and AA papers garnered the highest trade volume and turnover within the PDS segment for year 2015 through first quarter 2016. In the quasi-government segment, papers are typically long-dated and tightly held by investors, which explains its lower trade volume as compared to the PDS segments. So what's in store for the rest of 2016? Given that the global economy is extremely interconnected these days, developments in the international financial and economic landscape will be key factors to the domestic economic and bond market performance. So firstly, we have the crude oil price. Crude oil is expected to remain in the limelight as expectations of continuously large inventory builds lingers. In addition to expectations of growing supply, concerns around the pace of global economic growth, coupled with recently failed Doha talks among major oil producers, are expected to exert pressures on oil prices. Despite the recent rally in oil prices to about $45 per barrel, oil prices is not expected to recover to its $100 per barrel heyday in the next few months. And should the situation worsens, the recently strong ringgit and domestic financial market could see another round of sell-off. But all is not lost. There are possibilities that the current global oil balance may tilt from surplus to deficit due to supply disruptions arising from a wave of attacks in Nigeria, workers' strike in Kuwait, and chronic power outages in Venezuela. In addition, on the demand side, it was recently reported that India, the second most populous nation, could soon overtake China as the country with the biggest thirst for crude oil as its economy expands due to structural and policy-driven changes. Second of all, we have the BPAM monetary policy direction. After being at the helm of the country's central bank for the past 16 years, Tan Sri Zeti Akhtar Aziz has finally handed over her heavy responsibility to her deputy, Datuk Muhammad Ibrahim. Many analysts believe that as the deputy and member of the MPC, Datuk Muhammad Ibrahim is unlikely to significantly change the direction of the monetary policy away from the prudent stance that is currently in place. Furthermore, the BPAM governor had recently stated that the monetary policy remains accommodative and supportive of economic activity despite the first quarter GDP reading of 4.2%, hinting that a rate cut is currently not in the cards. But a noteworthy point is that Malaysia still has room for further monetary easing, with our policy rate offering one of the highest in the Asian region, and on the back of a relatively moderate inflation environment. This is unlike other regions where the efficacy of monetary easing is waning, and their central bank's ability to spur the economy is being questioned as they come close to the effective lower bounds of their interest rates. And thirdly, we have the US presidential election. It may seem remote that the election far in the West could affect us in the first place. But historically speaking, the presidential election in the US does play a role in global financial markets, as any unwelcome outcome to the election might introduce unfavorable changes to the world's largest economy. And this could affect every one of us across the globe. Hence, developments leading to the US presidential election in November is perceived to be one factor to watch out for in the second half of 2016. And next, we have geopolitical tensions. The recent developments in North Korea and the Middle East, as well as ISIS threats, are also a risk factor to watch out for, as it affects general market sentiments, which ultimately boils down to general financial markets' health. And after that, we have the Fed tightening cycle, of course. Following their first hike in December last year, the Fed was initially expected to embark on a tightening cycle with 4 rate hikes this year. However, in their recent FOMC meetings, it seems that the Fed is also concerned about global developments for fear that an aggressive policy path would jeopardize the nascent economic growth. Hence, with the more dovish tone expressed by the Fed recently, capital outflows from emerging markets is expected to ease as investors' risk appetite rises. Therefore, this factor would contribute positively to our domestic financial markets. With the announcement of retail sales beating expectations last Friday, all eyes are now on the minutes of the April FOMC meeting and the US inflation data that will be released tomorrow for indications of the next rate hike. So ladies and gentlemen, in view of potentially volatile times to come and the market fluctuations that we have experienced so far, we believe that every bondholder would need to track the market as closely as possible, while every bond issuer would need to tap the market as timely as possible. In light of these needs, we have recently come up with 2 strategic products to assist investors and issuers alike in strategic decision-making to achieve their financial goals. The Bond Tracker Report. With heightened volatility in financial markets nowadays, it is getting more perplexing for bond investors to be able to track and understand price changes of the bonds within their portfolios. More often than not, for non-market watchers, it consumes excessive resources to pinpoint the root cause of certain price changes over a certain time window. Hence, with the Bond Tracker Report, investors can now conveniently track the movement of their holdings up to a 5-year horizon without much hassle. In this report, we will analyze your inquired assets yield or price movement over the inquired horizon and produce a report with detailed observations of key factors that have caused significant movements during the period. We believe this report will be useful for investors in tracking the performance of bonds invested for internal reporting purposes and can also provide investors with additional insights for effective portfolio management. And next, we have the Reference Timing Report. Given the prolonged uncertainty that clouds the market, we note that sometimes prospective bond issuers simply missed out the best opportunity to tap the market and ended up with higher cost of borrowings relative to its peers. Hence, in our Reference Timing Report, we formulated a systematic methodology to perform a comprehensive analysis and assist potential issuers in spotting the right timing for new bond issuances. In this report, we follow a top-down approach where we will perform an assessment of macroeconomic environment tracking global and domestic developments via various indicators. Then, an analysis will be performed on issuer-specific risks to determine the potential demand and supplies in the specific segment. Finally, the report will combine the findings to shortlist an indicative issuance window in which issuers could tap the market with lower volatility and effectively lower cost of borrowings, and thereby capturing highest potential savings. So in conclusion, the recap on year 2015 revealed to us that both domestic and international developments form challenges to the Malaysian economy. But the ringgit bond market managed to pull through these challenges with a consistent year-on-year returns of 4.6%, underscoring the resiliency of the domestic market. And a quick overview on the first quarter of 2016 highlighted a number of challenges as uncertainty surrounding the emerging market slowdown and its potential on global economic looms. Moving forward, while the outlook for second half of the year remains cloudy, the ringgit bond market is expected to remain steady amidst uncertainties as it had always been in the past. Thank you.